Hi, this is Optimus Futures, and we're back with our weekly roundup of key futures markets for our viewers. As always, we will be starting off with the S&P 500 E-mini futures market. So over the past week, if you recall our analysis that we did last week, we talked about how it was really interesting to see the market actually move significantly past this former swing high over here and basically create a new all-time high that investors and analysts were looking forward to for quite a while, just looking at the strength of the uptrend here that initially led us to the point where the market actually broke out of this this really all-time high that the market made way back in January this year. Notably, though, we had identified how the break past this former swing high over here really did not quite trigger any kind of a pullback once again back to this area to use it as support and a further launchpad for more buyers to come in. And last week we had said that expecting the market to actually pull back to this area over here really wouldn't be that much of a surprise for us at all. And so really that's exactly what we saw last week. The market sort of just pulled back towards this former resistance over here, potentially to test it as support and possibly just allow for the market another launchpad to continue its way higher. Once again, we continue to see the 3,000 big round number mark for this market in the coming few weeks or months, depending on how the momentum or the buy side momentum here continues to sustain itself. Noticeably, though, the pullback itself really doesn't seem to be threatening to us at all. You can see that we had just moderately sized bearish candlesticks with wicks towards the downside, suggesting that the selling pressure here definitely isn't as strong as you would typically expect in a situation where you would expect the market to create a fake out, as in a move past a major resistance over here and then fall right back down underneath, use it once again as resistance and continue its way down. Instead, we have a typical sort of a rounded textbook kind of a pullback towards broken resistance that technical traders normally look out for to launch their buy trades. And just looking at the strong resistance that came in at this level in the past, it really wouldn't surprise us to see this turn into very strong support and allow for the market to just continue its way higher in the coming weeks. On Friday, however, we just had yet another bearish candlestick here. So we would like to identify that we so far have not found any major indications of support coming in at the 2870 level, where the market of course made the all-time high back in January, and of course is a very important level that a lot of traders and analysts would definitely be looking out for. So even though we expect the level to ideally hold as support and allow for the market to continue higher, we still haven't really seen any kind of support or any kind of buying really come in at this level just yet. We will, however, identify the fact that all of these bearish candlesticks actually line up in a pattern that we usually like to refer to as implicit divergence, which is that none of the candlesticks really have been able to close significantly below the prior candlestick's low. So if we just zoom out into this chart, you can see that phenomena right over here, which is usually an indication of slow or just lack of momentum in general. So if you can see here, pretty much this candlestick over here was not able to close below the low of this prior candlestick low, which was right around here. The next candlestick once again barely closed below the low of this former candlestick's low right over here, and then this candlestick on Friday once again did not close strongly below the prior candlestick's low. And so we really just continue to see this as just a market that's just pulling back to this strong level of support. And so we have all the more reason to believe that the market should potentially find support at this level and allow for more buying to come in. Although, like we said, we haven't really seen that buying come in just yet. It's something we would expect as a development in the first few trading sessions this week. Okay, so the next market we're going to be looking at here is the light crude oil futures market. Now, this is a market that last week, once again, just continued to follow the sideways market rhythm that this market has generally displayed over the last several weeks. We did find the market sort of holding up at the $1.70 price level right around here. So if you stretch that level back into a horizontal support and resistance level, you can see that we had a candlestick wick protruding above the $1.70 level, where the buyers obviously failed to sustain any kind of momentum and the sellers just took over. to basically just control the latter half of last week almost entirely. Still though, the market just continues to be more or less sideways. Of course, at the top we have the $1.75 price level that we will be looking at shortly as to why this has been acting as a ceiling for this market over the recent past. And of course, down here we have the $1.66 level that seems to be holding up as the floor for this more recent consolidation phase that the market has been in. Just zooming out to look at the weekly chart here gives a better perspective of why we're possibly seeing the kind of resistance that we're seeing at the $1.75 price level and the levels underneath the $1.75 price level. So if you stretch this right back towards the left, you can see that this is a major area of support and resistance, long-term support and resistance for this market at large. And so really no surprises why the market seems to be hesitant to continue with the strong uptrend that initially led us closer towards these all-important price levels for this market. Interestingly though, going back to the daily chart here, all of this selling coming in the market here is definitely pointing to the fact that the market is certainly trying to transition from a more smoother uptrend over here towards something that is a lot more choppy, sideways, and just a consolidation theme at large. And so really no surprises to see the market sort of hold up at round numbers. A weak market where no one party is dominant is usually very, very likely and is very prone to finding support and resistance, or basically just reacting at mid to short-term support and resistance levels, as well as long-term levels, including round numbers like the $1.70 over here. So no surprises to see the market sort of hold up at the $1.70 level over here last week, and its neutral close just tells us that the market just probably continues to be in this sideways theme here, unless we see the market sort of break underneath the $1.66 price level in a move such as this, pull back, maybe find some good formidable resistance here before continuing its way down, possibly to test all of these lows over here. We really wouldn't be we wouldn't really be expecting a lot out of this market in terms of any vertical price movements up or down. Looking at the upward scenario over here, if the $1.70 level just ceases to hold and the market pops right back above it, uses it as support, we could see the market potentially hitting back at the $1.75 price level right around here. Although, like we said, the $1.75 price levels and the levels beyond that actually line up with a very, very long-term support and resistance level. And just this overall theme that at large seems to be reminiscent of a market that is possibly rounding up at a very long-term and key support and resistance level, we would just be more inclined towards the possibility of the market breaking the $1.66 price level to possibly post a more extended down move and a major correction into the more longer-term uptrend that, like we said, initially saw us closer towards the important price levels like the $1.75 mark. Okay, so next up we'll be looking at the euro currency futures market. If you recall our analysis for this market the prior week, we had talked about how the fact that the market had closed pretty much at the 1.16 horizontal support and resistance level and round number, which runs right across this green line or arrow that we've drawn here, makes for a very interesting development this last week, which is of course because we wanted to see whether the market was going to hold as support at the 1.16 or push right through to allow for the market to post another extended move towards the downside. Well, we really didn't see much development at all last week, to be honest. We did see the market sort of hold as support temporarily for about 2 to 3 days, or rather the first half of the week. And on Friday, really, we saw the market actually push right back down to close very strongly underneath the 1.16 level, possibly telling us that the market could possibly post more sell-side momentum in the first few trading sessions this week, which could potentially put the market in contention to hit this low over here. However, we wouldn't really be as excited looking at just the strong close on Friday itself, and the reason for that is that even though the market technically closed underneath the 1.16 level, we're still seeing the 1.16 price level and round number as a thick zone of support and resistance, which means that price levels slightly under the 1.16 level and above the 1.16 level we also see as really obvious support and resistance levels for this market. So, for example, if you look at the push down here, we had a very, very strong bearish candlestick that closed underneath the 1.16 level over here. But the next day, the market was able to push right back up, once again telling us the ability of the 1.16 level to actually work as a zone of support and resistance levels instead of just one price level being the more primary support and resistance for this market. So even though we've seen the market sort of close underneath the 1.16 level, we'd actually like to see the first few trading sessions this week post a strong move towards the downside, possibly the market reversing or rather pulling back towards the 1.16 level, testing it as resistance, and then continuing its way down. That would then allow us or make us believe that the market could potentially post an extended move towards the downside. On the flip side, if the 1.16 level holds a support and on Monday we see the market pop up above the level once again, we would again want to see this level to continue to hold a support, and at least for the market to test these highs over here and look to break them for us to believe that the market was primed to make a move or an extended move towards the upside over here. So as of now, we're still pretty much neutral on this market, and once again we have the market closing on Friday pretty much very close to the 1.16 round number price level and a zone of support and resistance. So until we see the market getting cleared off the zone, we really don't have much expectations in terms of vertical price movement for this market up or down. Okay, so next up we'll be looking at the gold commodity futures market. Now this is a market that was really interesting for us to follow despite the fact that we didn't see a lot of movement for this market in the prior week. And the reason that was very interesting to follow is that we did not see typical market action or market behavior displayed by this market in the prior week. So if we just elaborate on that, you can see that the market actually closed at the 1200 or just about at the $1,200 round number and horizontal level of support and resistance. Earlier we had the market sort of push down strongly underneath the level. We then saw a nice looking bullish pin bar over here as the market turned right around and closed above the $1,200 level over here, so as to make all this move underneath the 1200 level as a fake break of the level itself. However, we did not see what you would typically expect the market to post when it's basically in the middle of a typical breakout play. Fake out play. And the reason for that is that the market pulled back to this level and really didn't hold a support, which you would typically expect, right? So you would actually expect the market to close above the 1200 level, pull back, use the level of support, and continue its way higher. We did not see that happen last week. We actually had the market close underneath the 1200 level over here on a strong note as well. And then in the next couple of days, the market, instead of just continuing its way down, possibly to be in line with all of this down move over here and all this sell side pressure that's been building towards the downside, minus this move from the buyers over here, we actually saw the market sort of just consolidate and oscillate around the 1200 level within a very, very tight zone of price levels over here. So we sort of just have the market dying out at the 1200 price level. So even though we were initially looking at this entire move underneath the 1200 level as a fake breakout, and we notified last week of the possibility of the market actually reversing off the 1200 level if the 1200 level was to hold a support. Well, it's not holding a support, or not holding as support as well as we would have expected if you were really optimistic about this entire fake out scenario that this market had initially posted. So just looking at the overall momentum that is more towards the downside for this market, just looking at this action dying out at the 1200 level, this to us could possibly be an indication of exhausting buy-side momentum for this market, and that could actually trigger for more selling to come in the market, and possibly the market moving underneath the 1200 level more strongly this week or in the weeks to follow. Once again, we see the reasoning behind this expectation coming from the fact that the market really doesn't seem to be that interested in holding at the 1200 level as support. In fact, if we just zoom out into this price action over here, we actually sort of see this market maybe even tightening inside of a wedge pattern right at the base of the 1200 level over here. So if you just go on to a lower time frame, you can see this market development a lot more clearly. So if we just draw this rising support trend line over here and a descending resistance trend line over here, the 1200 level of course runs right around here. You can actually see that the market is possibly tightening inside of a wedge pattern over here. The swings that the market is creating are beginning to get smaller and smaller, which is again a characteristic of the market tightening inside of a chart pattern usually. So this tightening here, or the squeezing of price action within a tight wedge pattern, pretty much at the base of the 1200 round number, could be a good launch pad for more selling to come to the market, or for that matter even buying if the 1200 level eventually does end up holding as support, because as it is now, the market is pretty much sitting at the level instead of underneath it, or above it really. So while we're pretty much open to both scenarios, just looking at how the fake out didn't exactly play out as we would have expected here, simply because the buying or the momentum from the buyers really just seems to have dissipated here. We would just favor the market to possibly break underneath the 1200 level and just continue its way lower. Just looking at the overall momentum over the past few months that that the sellers have been able to post for this market. Okay, so finally we look at the 10-year Treasury note futures market. Now finally for this market, after several weeks of very dull price action, on Friday last week we saw the market actually post a strong move towards the downside. So technically this is still just a single candlestick with an interestingly and excitingly larger trading range. The market still, for the most part, just continues to be consolidating around the 120 round number, which obviously runs right around here. You can see ample evidence in the recent past where price either found support or resistance off of this price level, and the more extended consolidation phase that the market has been in more recently, this level here, the 120 round number, really has been acting as a pivot, and the market has just been reacting back and forth above and below this level for quite a while now. On Friday though, we saw an interesting move right underneath the 120 round number, and the market actually closed strongly. If you recall our analysis for this market the prior week or the weeks prior to the prior one, we actually have been identifying this market possibly tightening inside of a chart pattern over here, resistance coming in at the 121 level, and this rising support trend line, where we now have two touches. This strong close on Friday actually sort of is very, very close to this rising support trend line, and that sort of makes for an interesting situation for this market. We would just like to recall at this point and remind our viewers that the market at large has been pretty much downtrending. It's only in the recent past that we saw this market sort of hold up around the 120 round number, and this just strong move on Friday could possibly be indicating the possibility of the market breaking underneath the rising support trend line, possibly this week or in the weeks to come, and just continuing its way down so as to continue with the more longer term downtrend theme that this market has been exhibiting over the past several months. So even though we see this market still sort of caught up between, or rather in the middle of a consolidation phase here, the strong move on Friday does seem to be a refreshing attempt from the sellers in this market, and could possibly be indicative of more sell-side momentum to be coming in the week or the weeks to follow.